Omar, able to hold 32.85 here. Is there a sense in the very short term that markets can maybe live with some of these 1 month lockdowns that we're hearing reports about in Germany, for example?
Well, yeah, it is clearly a risk of related to people extrapolating what these may look like, and the strength of the recovery we got so far. Obviously, the markets did have a very strong recovery, but the consequences to the economy, it is what the market seems to be grappling at today. The lack of the fiscal stimulus in the U.S. and its consequences obviously is not helping the situation going into the election week next week.
Omar, we're seeing some of these stocks still in the green. Netflix, Peloton, DraftKings, these are some of the stay-at-home plays. Where do you see the opportunity now?
Well, I think the key component in all this is the cycle we're getting to coming out of our recession. And if you think about, the historical views of recovering through the recession, they usually tend to be value-driven. They tend to be areas where you normally see, spreads in valuation being attractive. The big difference in this time around is that we're not out of the recession because the source of the recession in this particular case was the health crisis. And what we see in the market focusing out today, it is continued to be on the number of cases and the potential issues that this has down the road. Now, the interesting thing about the companies you mentioned, as well as the majority of the companies that have led this market, is that they are the ones that continue its growth and it continues to have prospects and good outlooks and free cash flows that will continue into next year. So those opportunities are not going away, even though they have actually done well. It's not surprising that companies that can generate cash flow and have sustainability of earnings will continue to lead. I would actually say that it will take us some time to rotate to value until we get a good sense of where the virus is going.
Brian, welcome. You make the argument that the markets seem to be paying attention to the election only to the extent that the size and timing of fiscal stimulus comes into play, and that a blue wave actually means bigger stimulus. So my question is a blue wave priced in at this point, or is divided government priced in? And how should investors play it depending on which we end up getting next week?
I don't think either outcome is 100% priced in. I think investors have probably learned or maybe even overlearned the lessons of 2016, which delivered a genuinely surprising outcome if you looked at the polls or the betting market. So right now, look at the betting markets, it's 65-35. Some of the polling models have this as a 95-5. So there's a big gap there that tells me that the financial markets are probably not pricing in, or at least fully pricing in, a blue wave. You would see, I think, a weaker dollar. You'd probably see somewhat wider inflation break-evens. But I think it's absolutely correct that the election has taken on new importance in the mind of the market because the stimulus package now hinges on the outcome, both the timing and the size. If we had gotten a stimulus package earlier in the current kind of alignment of government, I don't think that would be seen as big a deal. I think you'd be seeing the markets paying more attention to, say, the Biden agenda. But in this case, the hopes for a fiscal stimulus, a large fiscal stimulus, are probably best in the first quarter and could be in that $2 to $2.5 trillion range, which I think would certainly help in terms of fiscal relief, but probably not until the second or third quarter of the year next year.
Shepard Smith here. Thanks for watching CNBC on YouTube.